I'm Alan Mendelson. You know me as being the financial reporter on the CBS television stations in Los Angeles. Now I want you to meet certified financial planner Brian Gilder, who can help you get through today's troubling financial times.
Well, what you need to do is you need to take a deep breath, and you have to look at it this way. In my opinion, and I think most people understand this, is that right now this is a big baby crying. And it's fussy. And it has a right to be fussy because when you think about what has happened in this financial market, unprecedented events have happened. Bankruptcies, bailouts, insurance companies needing money, AIG needing $85 billion, Lehman Brothers, one of the oldest brokerage firms in the world, 150-year-old company, filing bankruptcy. All this year, Fannie and Freddie Mac. I mean, the list goes on, unprecedented. So the market is very jittery, and you've seen in the last couple of weeks 1,000-point swings. Never seen that before. The government is trying to fix this problem by putting together the $700 billion package. Commercial paper to help free up the credit markets. Taking some ownerships in banks, if need be. Lowering interest rates. They are doing everything they can, just like a parent does everything they can to soothe that baby at night. But sometimes, right now, you have to let the baby cry. You got to let the stock market take its lumps. You have to think of this long term because that is the way the financial markets are. And if you look back in history, we've had crisis before. We had the '29 crash. We've had oil problems. We've had wars. We've had everything happen to America. You have to think of this long term.
How long is long term? How many years do you give it?
I would give this at least a couple of years, and I think it's going to be longer in my opinion. But I think you have no business to be investing in the stock market if you have this short-term 2-year or 4-year time horizon, or even a 6-month time horizon.
So what do you do during the short term? What do you do during the next 2 to 4 years?
Well, the first thing I would do is I would go back to the basics, because I think many people have tried to take shortcuts in financial planning over the last 5 to 10 years. You see these newsletters out all the time about quick profits, swing trading. You've seen analysts on TV talking about these are great, this is a great buy, this is a good buy. But people have gotten sucked into all this short-term hype of the financial markets. I think you need to take a couple steps back, look at your financial portfolio, and look at the number one thing. Look at your credit card debt. No one looks at this. Everyone talks about how great their investments are. You're earning 10 or 15% in the market, but you have 15 or 20% you're paying in credit card debt. People always ask me, what's the best investment? Credit cards.
Pay off the credit cards.
Pay off your credit cards. Get that under control. I would also stress to people, keep investing in your retirement plan, especially if your company's matching you. That's free money. Even though the story about the $2 trillion lost in retirement, currently that is, but let's see what that's going to be 5 years from now.
Do you keep making regular investments into a long-term investment plan?
Absolutely, long-term. The key is long-term. If you don't have at least, I would say, 7 to 10 years until you need the money from the financial market, you have no business in the market. And there's nothing wrong with keeping your money in CDs or money markets or bonds that are safe, even if you're 30 or 40 years old, because if you can't sleep at night, don't invest in the stock market. You're going to be up really late with that baby.
Some people might consider bailing out of their 401ks or their retirement funds because they see those funds dropping in value. Big mistake?
Huge mistake. Not only because from the investment standpoint, but you could have tax consequences. And not only tax consequences, but tax penalties, especially if you're 59 and a half or under. Because if you take money out early from a retirement plan, you will be hit with tax penalties. Well, there are some exceptions, but more than likely you will be hit with tax penalties.
Everyone's goal is to buy low, sell high. Do you pour money into the stock market now?
I would not buy individual stocks.
Should people make a lump sum investment now, or is it better to buy stocks over time?
It's a debate. There's a lot of debate about that. People say we should invest all the money now because over the long term it's better. I don't believe in that, and the reason why I don't believe in that is because psychology plays Psychology plays with the mind. Because if you invest $10,000 and the market goes down another 15 or 20%, you've already lost, you're down to about $8,000. So I would do it over time, so that way you feel better with yourself. If the market does go down, you say, oh, the market went down, I'm putting a little bit more in now, I'm buying a little bit low. Even if it goes up, you're saying, well, I still bought at this price. I think psychology plays a lot. It's, to me, the theory and reality game. In theory, you should be doing certain things, but the reality is that you shouldn't be.
What percentage of your investable money should be in the stock market?
I think it depends on your age, how you are situated, your risk tolerance. But if you're someone who has a long time horizon and you're young, you don't need the money for 20, 30 years, you can put 50 to 70% of the money into the financial markets. But make sure it's diversified. You do not want to put all your money into one sector of the market. You want to spread that money out. So diversification is the key. I can't stress that enough.
So you're talking about putting your stock market money into different sectors.
Absolutely. It has to be diversified into different sectors of the market. I think also a big mistake people make is they don't look at if they put money in different sectors of the market, such as in mutual funds, and this mutual fund is supposed to do X, Y, and Z, and this mutual fund is supposed to do this. Look at all those mutual funds and look at what they're exactly putting that money into, because usually they'll disclose all the large holdings they have. Make sure Fund A and Fund B do not have the same holdings and same characteristics, because many funds mimic each other. So you want to make sure that this fund is investing in Europe or in the foreign markets. This fund is investing domestically. This fund's investing in financials. This fund's investing in healthcare. You want to make sure everything is spread out, because diversification is the key to any investment.
You can get more information from certified financial planner Brian Gilder. Call him at 310-804-3767. Again, 310-804-3767. Or write to him at 8383 Wilshire Boulevard, Suite 240, Beverly Hills, California, 90211. I'm Alan Mendelson. Thanks for watching.